Condo prices flatline while single family homes continue to appreciate. Mortgage interest rates, which dipped to 6% in September, have risen since. So, what's next for the Hawaii real estate market? Find out next with economist Paul Brewbaker.
Market trends and forecasts, outlook for buyers and sellers, key insights from the experts. Welcome to the Hawaii Housing Report with economist Paul Brewbaker and Patrick ONeill.
Okay, here we go. All right. Well, Paul, good to see you. It's been 2 months since our last market update. I have to say, I kind of missed you a little bit. How are you doing?
Missed you guys too. I
Good to
didn't
hear.
realize we skipped a month. That's weird.
Yeah, we did skip a month, and a lot's happened. So,
A
we're
lot
gonna,
has happened. Yeah.
yeah. So we're gonna talk interest rates. We're gonna talk about buyers market versus sellers market, and looks like there's opportunities in some places. And
Right.
I've got a fan question for you coming up when we talk a little bit more about condos. But why don't we start with pricing? And then this has kind of been the tale of the two worlds that we've been looking at. This is the latest data from the Honolulu Board of Realtors. And we start off with single family homes, the year to date figure for median price, 1,150,000. And you can see with the statistics here, it's up 4.5% from last year. It's up 9.5% from the year before that, and up 4% compared to 2022. This has just been that steady long-term price appreciation that we normally expect, right? Around 4.5% to 5%.
Yes and no. There's a nuance we'll come to. I'll show you. But yes, you're correct. This range of 4 to 4.5% has been pretty reliable for 10, 15 years. That 9.5% in 2023, we'll talk about in a second.
Okay. All right. And now on the other hand, the completely different side of this, here's the condo median price. So year to date,
Yeah.
we're at 510,000. That's unchanged from last year. Same exact number. It's up 0.6 from 2023. It's
Yeah.
basically flat. And compared
Yeah.
to 2022, down 1%. It's just been flat from 2022. Anything that you expect to happen that's going to change that trajectory?
No, but this is important. If one market segment is essentially going up at the historic rate for 4.5%, with some, variation from time to time, and the other segment is sort of sideways, 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 net, 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 right? That's okay. Something completely different is happening in those two markets, and we need to remind ourselves of that, and also look for even deeper nuances. You want me to show you what I'm talking about?
Sure. Yeah, absolutely. And
Yeah, here are
obviously,
those.
yeah, and obviously
Yeah,
with the condo, we've talked about it multiple times, but you've got the age of the condos, deferred maintenance, the
bunch of
underinsured
stuff.
issue. Yeah, a bunch of
Yeah.
stuff.
Absolutely, all important, still important. You recall, I like to remind everybody that cracking down on vacation rentals and some tough years for tourism has changed part of the condo market, not a big part, but a meaningful part. And so, as you say, many factors pushing those condo prices flat for 2, 3 years now, pushing it off the longer term historical trend, which is closer to 5% than 4%, which is one way of saying condos were playing catch up in the 20 teens pre-pandemic. But again, they've fallen away from trend. And the good news, I guess, is that they're actually getting more affordable
Hmm.
because as interest rates come down, prices aren't going up, incomes are going up. That's that's as good as gets without prices actually going down. It's next to as good as it gets for condo buyers. Condos are the affordable segment, of course, relative to single family homes. So I think, people in a position to invest or maybe in a first-time homeowner, first-time home buyer kind of a period in their life cycles, may want to take a look here. Now, the real uh, interesting part of this is over in the single family side. And let's close up now on this post-pandemic. You remember we had this post-pandemic surge. We think a lot of that had to do with the one-time shift to remote work. Most recently, well, you've seen that 4 to 4.5% with a bit of a 9.5% in there. There's that's just this variation here, but generally speaking, for 2, 3 years now, a pattern of parallel movement to the old 20 teens trend. There's that old trend. It goes back
Hmm.
to 2012 and now moving in parallel, unlike condos. Here's the thing I want to focus on just a little bit more tightly. I seasonally adjust the data. So there's regular seasonal variation in sales volumes and in pricing as partly as a consequence of that. And we were kind of bummed out for a lot of 2025 as we saw this unraveling of that parallel. If this is a 4% trajectory and we're on a parallel 4% trajectory that's higher, well, that means more expensive for buyers, but you know, better for owners. We saw this erosion in the first half of 2025 that started to look like a break from this parallel trend. But just the last few months, there's August, September, October, that to me, after seasonal adjustment, looks like a rebound back to this parallel trend, a
Oh,
restoration of the comparative robustness of the single family segment that we've seen once this post-pandemic bubbleiciousness tamped down and moved us into this new parallel path. Again, condos flat, good for buyers. Single family looking like it's moving back right back up to the trend that was newly established in the early 2020s. To be continued, we'll see.
hi, it's Patrick. If you're enjoying this information, please do give us a thumbs up down below and be sure to subscribe. Yeah, very interesting. So I ran into someone who watches this and is a fan of yours
Mm-hmm.
and had a very specific question about this, which is
Oh,
on the
okay.
condo market, because it
Yeah.
does seem like it is a really good time to go in and buy. Putting, if you can figure out all the other issues, involving each
Sure.
individual condo, do you see anything that is going to change that dramatically in the next year? Like, are we going to wake up in 2 months and go, oh my gosh, I missed it. I should have got in while condos were low?
Well, that's why I sort of brought up this, you know, um, miraculous recovery of single family prices. If it is one, it's certainly a V-shaped bounce back to the old trend and then right back up in a very short period, essentially 1 quarter, to the path that had been newly established in the 2020s, above the one established in the 20 teens. Condos, again, as you say, there's something unusual going on, but in both cases, I mean, something unique or idiosyncratic to condos is not present in the single family space. But as you point out, thinking about this in a forward-looking perspective is really challenging. We have the uncertainty of tariffs still lingering. Every day there seems to be a new not a deal. I mean, what's up with that? When do we actually get a deal? Now we have a new framework for a new framework for a new framework for a deal. I mean, it's crazy stuff. And then
Yeah.
of course the government shutdown, which maybe winding down if the Congress can get its act together, and a host of other things. I don't want to go start making lists, but the
Yeah.
uncertainty that's been present, that was present a month or two ago when we last got together, still lurking. So again, a prudent investor is going to weigh all of those factors that are in play. But to me, the rate environment is improved enough. The fact that those prices are not rising, kind of an invitation to look carefully and to contemplate your personal risk tolerance against the possibility that condos may be undervalued relative to single family homes,
No.
may be undervalued relative to condos sometime in the future.
Yes. And then in condo market, generally a little more rate sensitive because it is for a lot of people, it's going to be that first step into the real estate market. The rates are certainly going to have an effect on that. And speaking of rates, so in September, interest rates dipped down to basically 6%. They've risen since. Let's bring
Mortgage
in
rates,
our
yeah.
expert. Yeah, mortgage rates. Let's bring in our expert, Anders Hostelli, regional manager at Rate
How's
Mortgage.
it going, guys?
Good, good to see you. 2 months. I
Good to
missed
see
you
you.
too, not
I
just
know,
Paul.
man.
Yeah. So when we met last time, the official Fannie Mae rate was 6.22 for the 30-year
Mhm.
fixed. Where are we sitting today, Anders?
We are right back there. So yeah,
Is there?
it's about 6.25, 0 points. So yeah, we saw the rates had come down to about 6% with zero, but now they come back up, but they're still quite good. I mean, yeah, it's definitely a lot better than earlier in the year or last year, of course.
I see. So the 6.2 where we were last time, I'm going to pull up. This is the latest from
Mhm.
Fannie Mae. Sorry, get in there, you. Okay, so
Sure.
when we look at this, oh yeah, I see. So right now, Fannie Mae right at 6.22.
Mhm.
This was the last information that they released. And Anders, what about adjustable rate mortgage? Where would that be in comparison if we're at 6.22 at a fixed?
Yeah, so it's about a 0.5% lower, and this is Freddie Mac, right? So Freddie Mac, there's Freddie Mac, Fannie Mae. So yeah, it's for a 5-year arm, it is about roughly about a 0.5% lower than a 30-year fixed.
I see. And just to remind everybody, adjustable rate mortgage, that is locked in for X amount of time, right? That first part of the rate, maybe a 7 year.
Yeah, and I mean, long time ago, you would see these 1-year arms or, I mean, there is a 3-year arm. They do have it. Banks have 1 year and 3 year, 5, 7, and 10. But the kind of the typical arm that you see people taking it is at least fixed for the first 5 years.
Yeah.
So it's called, a 5-1 arm. So that, yes, that's what we see. So,
Okay.
and that's what I'm referring to, which is, that rate is roughly about a 0.5% lower
Okay.
than 30-year fixed rate.
Okay. And then Anders, I wanted to talk to you about this. There's mortgage rate lock effect, which is real, right?
Mm-hmm.
People are locked in. This is the latest data that we could gather from two different sources. 72% of mortgages across the country are below 5%, 54 below 4%,
Right.
almost 40 are below 3.5%. What do you think is sort of the magic number that starts to release some of that inventory? Where do we need to be?
Low fives. So maybe about 1% lower or 0.75% lower than we see today.
Yeah,
Yeah.
I see.
Yeah.
Okay. And one of the things we were talking about earlier with Paul is this dichotomy between the single family home and the condo market. And one of the
Mhm.
really big drivers of the value depreciation and flatline has been this issue of underinsured condos. And I think more and more people now understand the issue, understand what it is. If you don't know what I'm talking about, go back and look at the Zoom we did with Sue Savio, Anders and I, and you'll
Right.
get a real handle on that. But Anders, what's the difference if I buy a condo that is fully insured versus
Mhm.
one that's underinsured? What's the difference in the rate? What's the difference in my monthly payment?
We may, and maybe not today, but maybe the next time we can talk also about that. And I know we brought it up before, the Fannie Mae approved list, not approved list, and all that. But
Yes.
let's just kind of talk about, as far as the insurance goes, for a condo that, let's say, doesn't have 100% hurricane insurance compared to one that does have. Let's say if that building is saleable, has no other issues, we can do a Fannie Mae or Freddie Mac loan at 6.25%. I'm just using 750,000 as a loan amount. Your principal and interest is about a little over $4,600. Um, Now, if there is not 100% hurricane insurance, there's only a few lenders that will actually lend in those condos. And that rate is roughly about 1% higher,
Mm,
the mortgage rate. So then that would be on the same loan amount of 750,000. If I use 7.25 as the interest rate, the principal and interest is about 5,100. So it's like a $500
wow.
difference
Yeah.
per month.
And
Mhm.
that's real money for
That's
people
real
buying
money.
in a
Yeah.
condo, and we certainly see that effect.
Mhm.
Okay, and let me again bust out the crystal ball.
Yeah.
Um, we're in November. December, are we going to see any further drops, do you think, in the mortgage interest rate? Do you think the Fed's going to cut rates again? Where do you sit with that?
Yeah, personally, I just feel like we're going to kind of bump along kind of where we're at now. Maybe it'll get down to that 6% again, but it just seems like every time now that, recently that we've hit that rate, it comes back up a bit.
Right.
So I think we're going to just be kind of where we're at now, or maybe a
Okay.
little bit lower.
All
Mhm.
right, great. Anders, thank you very much for making the time to be here and give us your insight. It's
I
always
appreciate
super
it.
valuable. Yeah, and thanks for all the help throughout the week as well. Stand by. We'll
Absolutely.
be
Thank
right
you.
back with economist Paul Brewbaker. Okay, and we're back with economist Paul Brewbaker. Paul, any other thoughts about interest rate, sales volume, what you see heading forward?
Well, of course, the big question is whether the Fed will continue the string of overnight interest rate decreases that it's enabled in the evolution of monetary policy. They keep saying, the Fed keeps saying it's data dependent. They're looking for imbalances between risks of inflation and risks of unemployment because ordinarily they move in opposite directions, but this year because of the supply shock of tariffs, they're both on the way inching upward just a little bit, and the question is which one's going to be worse. Um, my guess is that maybe the tariffs aren't going to generate as much inflation as we originally were concerned about, but then that would shift the balance of risks towards unemployment, which might induce the Fed to continue decreasing rates. I honestly don't know. And as Andrews talked about, with that 10-year, the yield on the 10-year U.S. Treasury note, unconvinced that the bond markets can't convince themselves to take that 10-year note yield under 4%. We're kind of stuck with the 6% or 6.25% mortgage, unfortunately. One final bit of news, only because it is actually news. The Fed did announce last time that they will be ending their quantitative tightening. So the reduction in the size of their balance sheet will be discontinued on December 1st.
And the net effect of that is,
Well, they won't be engaged in adding or subtracting securities to the market in the way they have been. As you can see, each of those big pulses where they injected liquidity and bought securities was a momentous occasion. They've been allowing that to unravel, and they're going to call it quits at the end of this month. And what will happen is, as mortgage-backed securities mature and roll off their balance sheet, they will replace those securities with Treasury securities. So they'll keep the size of the balance sheet relatively stable, and therefore remove the influence that they've had for many years now, really going back to the 2008 crisis, on the sheer volume of bonds, being absorbed by the big 900-pound gorilla that they
right?
represent in the bond
Okay.
market.
Yeah. Okay.
Take out the training wheels and let us ride the bike
See what
ourselves again.
happens. Okay, so let's shoot back to some real estate statistics. These are active listings for sale on Oahu, and with single family homes. So 775 homes for sale in October. That's up 4.6% from 2024. It's up 24% compared to 2023. And this is where we start to see big separation again between the single family home condo market. So condos for sale, 2,341. That's up 20% from 2024, but it's up nearly 80% from 2023. And if we go all the way back pre-pandemic, 2019, we can see single family home inventory. We're still missing nearly 50% of that inventory. And that's that tightening, limited supply that's driving up the values, certainly. And then condos, we see it's basically the same amount of inventory available for sale going back to 2019. We jump over into closed sales. So this is year-to-date closed sales for October. And I'm just going to go right to the pre-pandemic comparison. We're down 24% for single family home volume, down 20% for condos in volume, number of sales. That's not that far off from 2019, meaning it seems like it's fairly robust, and it seems like the closed sales are becoming more and more robust and a little more active despite the interest rates where they are right now.
Yeah, I think that's fair as a characterization. I do think the fact that they're kind of moving in opposite directions ought to lead one to, recognize that there are different factors at work in the two segments, and
Yes.
we need to be have pay continued attention to that. It is the case that when you combine condo and single family sales together, they're moving as you'd expect inversely with the mortgage rate. So here, the mortgage rate on the right-hand side of the screen is upside down, moved from 7% to 6%. More fixed rate mortgage interest rate is actually an up move in this chart, and I've lagged it a couple months. So the picture looks like the mortgage rates are leading. But I just want to point out that uh, sales volumes did actually speed up a little bit this, notwithstanding the low ebb that they're at. And I have adjusted for seasonality because we're entering a very, quiet period of the annual sales cycle. Nevertheless, in the last few months of late summer, early fall, those sales did seem to be picking up a little bit in total compared to a less supportive mortgage interest rate environment.
Yes. You touch on the seasonality, and I know you take
Yeah,
that out, and we've looked at those charts, and it's kind of crazy
yeah,
how accurate it is going back many, many, many years. And we are entering into this November, December, January, where
yeah.
traditionally we definitely see a huge dip on closed sales. And then it seems
Mhm.
like February and the month after that is when sales really start to take off again.
Yeah, I mean that's true of a lot of corporate budgeting is the same way. Nobody has any money left in their budget at the end of the year, and then all of a sudden the board of directors says, "Okay, now you have to take on all these initiatives in the first quarter." But with Hawaii, there's also a separate factor, which is tourists come out to Hawaii in the winter. They tend to stay longer. They kind of look around and think, maybe we should have a condo, and then you see those sales uh, add to what's ordinarily an upswing in the spring and the early
Yes.
summer. Um,
Well,
so
we definitely see that. Okay, now the big question is it a buyer's market, seller's market? What segment? Let's check
yeah,
this out.
yeah.
Okay, so Paul, this is the statistics for months of remaining inventory. And just to remind everybody, we think of market equilibrium between buyer and seller market, about 4.5 to 5 months of remaining inventory. Anything below that, a seller's market. Anything above that, a buyer's market. So let's take a look, and I'm going to do this backwards. So going back to 2019, we're at 3.4 for homes, 3.8 for condos. That would be in the range of I'd say call it a moderate seller's market. 2021, it goes crazy, right? So homes are at
Hmm.
1.1, clearly a seller's market. Condos at 1.8, clearly seller's market. We get to 2024, we start to see a little separation. Homes at 3.3, condos at 5.4. Now they're right in that equilibrium zone. Now, as of October, condos at 6.4, clearly in a buyer's market range. The homes remaining at the 3.3 in a seller's market range. What do you make out of this? And is this just another confirmation of this separation of the two?
This is a perfect example of that separation. And let me share a screen with the same data you're showing in your table, only seasonally adjusted. We just talked about seasonality. And it's really striking how that pileup in inventory was so much more acute in the condo segment for the reasons we talked about earlier, insurance problems. There's some vintage issues that seem to plague Oahu condos maybe a little bit more than what you see on the neighbor islands. But I think it's interesting, again, on a seasonally adjusted basis, to note that just the last 3, 4 months, these inventory pileups have begun to reverse. So, in addition to the fact that we switched in the condo segment from a seller's to a buyer's market, and it's still a buyer's market on balance in condos, both of them are starting to tighten up a little bit. And I just can't stop emphasizing, but let me put it in the historical context, how important the separation between those two segments really is, because historically, there's never been a time, except for maybe in the mid 1990s in the unwinding of the Japan bubble, but that was really a separation where they were crazy high, 2 years of inventory remaining, where they were both transitioning to a rapid descent into what we call the subprime bubble today. Today, the separation is completely unique to the condos, and I can't say enough. It's important to understand that something's going on there that's not happening in the single family market that really distinguishes those two segments and this moment in the real estate market here on Oahu.
Yeah. So, Paul, let me ask you this. All this past year, it's sort of been the same. This single digit price growth for single family homes, condos just kind of flatlining the whole time,
Sideways.
volumes.
Yeah.
Yeah, just it's looked like that. as we look forward, let's say in the next 12 months, as we look into 2026, is there anything that comes up on your radar that you think either could be a major headwind that comes up against values, or something that all of a sudden can just boost values quickly?
There are risks out there, and I'm concerned that if one or another of them manifest, for example, the economy slowing down dramatically, which would bring interest rates down, but then create a kind of a uncomfortable environment for real estate investment, or
Mhm.
maybe a more risky one, something like that. Or if there's a bubble in AI stocks and the bubble bursts and we get back into the sort of the dot-com unwind, um, things could go either way. Now, back in the late 1990s, when the dot-com bubble burst, what happened was a lot of investors shifted their focus away from stocks towards real estate. And we ended up with a bubble in the housing market, which isn't the greatest outcome, but does suggest that a certain amount of substitution. So lots of uncertainty. Um,
Mm.
what I would say is that as I look back on 2025, it seems to me that it was one big pause button. I mean, the sort of the general theme of the year was you thought something was going to happen, it didn't, or weird things happened that you weren't expecting at all. Just a lot of people kind of like, wait, what? And we may get out into a new year with some resolution of that befuddlement that's been weighing. Now, in the AI space, obviously nothing but upside, or all 10 stocks or whatever it is.
Mhm.
But that seems like an outlier that we can't really generalize to the rest of the economy. And then, as you've pointed out, and we've been talking about for a while, this thing with the lock-in effect, everybody's trapped in their house with a low mortgage, makes for a real challenge getting people out into this asset class, renewing their interest in physical relocation or just being more active investors um, in this
Yeah.
segment of the asset market.
I have many friends and clients that say that to me all the time. I want to go buy a new
Is that
house. We're
right?
having another kid. Can't do it. I've got a
Well, can't do
3.8,
it.
3.8
Yeah, right.
fixed mortgage. I'm not moving for a 6.5 or whatever it might be. So yeah, certainly something unforeseen when rates got that low, but good for everybody who locked in. So
Lucky for, count your blessings, stuff three kids into the bedroom for the moment,
that's
and
right.
maybe something will happen.
That's right. Old school. Let's go. All
Let's
right. Well,
go.
hey,
Get a bunk bed.
yeah. Paul, thank you very much. It's always such a pleasure to catch up with you and get your insights. So for everybody watching, until
Patrick.
next time, be well, be kind. Aloha.
Aloha, brother.